Good morning, good afternoon, good evening, wherever you're zooming in from. Welcome to a very important discussion, one that's critical for any international business, one on international tax. We don't want you to go to jail. We don't want you to lose sleep. We want you to be a healthy business and obey the rules, make a lot of money and continue to grow. That's what our mission is for our members. And so we have two really important guests today who will be sharing key information for you and your business as you grow and expand and restructure and do all the things that you're doing around the world. My name is Doug Brunke. I'm the founder and CEO of Global Chamber. I'm really pleased to first introduce Shannon Lemon. She's a CPA. She's a partner in charge of international tax at Eide Bailly. Eide Bailly is a multiple-year member of Global Chamber. We're really pleased to have their activity within the chamber, and really pleased to have both she and Aaron Boyer, who will be speaking after her, sharing this information today. Shannon is zooming in from Colorado, and Aaron will be zooming in from Minnesota. Shannon, take it away. We look forward to learning more.
Excellent. Thank you, Doug. I'm just going to share my screen here. It's wonderful to be with you all today. We have been working with many companies that find themselves in different situations than they are used to, of course, during this COVID season. And so we wanted to share with you today some of the things to be thinking about, some of the things that we have encountered and our clients have encountered as well. So you've already had a bit of an introduction to us. I lead the international tax team here at Eide Bailly, and Aaron is one of our key senior managers on the front lines of helping our clients with the different issues that we're going to talk about today. So our objectives really are to take a look at the residency from an individual standpoint and from a corporate standpoint in terms of people working in different locations, etc. This is really the most important part of our discussion. The residency impacts things from an individual and a corporate tax perspective. So we'll talk about some of those implications related to income tax, employment tax, and the estate tax. Also talk about some of the individual global temporary relief measures that were enacted by various countries. And throughout this presentation, we'll just talk about some best practices on managing a global workforce. So with that, I will kick it off to Aaron to move through the individual considerations.
Thank you very much, Shannon. And thanks, Doug, and to the Global Chamber for the opportunity to be here today. As Shannon mentioned, some of the really kind of key components to international tax are related to residency and kind of taxable presence. And from an individual perspective, when is an individual subject to tax in a jurisdiction? And from a company perspective, you know, when a company is starting to touch another border or another country, at what point do they have some type of tax filing obligation or an income tax liability? So with COVID, what we're seeing quite a bit of with the residency is we have kind of this foundation of rules that we work with that sometimes are fairly complex and require planning. And now with COVID being added onto it, it's added in this additional flavor, additional layer of complexity where, you know, some of it, obviously we didn't plan for COVID, and we didn't plan for some of the wrinkles that it threw in to some of the planning and some of the residency rules. So as we talk through these, we'll keep it fairly high level and also probably look at it more from a US perspective, but it can also work vice versa. You know, individuals are coming to the US and there's there's tax considerations related to residency. It also kind of applies for US persons that are going abroad. So this concept of residency for individuals, typically, if you look at it from a US tax perspective, if you have a foreign person that comes to the US, typically they're not subject to US taxation unless they have US source income. So if you have a non-resident alien, they're only going to be subject to tax on their US source income, not their worldwide income. So if you have somebody coming from Canada and they have wage income in the US would in general tax that income. But if they have rental income in Canada, investment income in Canada, when they're a non-resident alien, they're typically not subject to US tax on that income. On the other hand, if they become a resident alien, then at that point, the US taxes their worldwide income or picks up the worldwide income and subjects it to US tax. So you can see that from a residency standpoint, that's a pretty big factor because you go from non-resident only subject to US tax on their US source income to a resident to now they're subject to US tax on their worldwide income. And that works both with other countries as well, as we'll see maybe on a couple other slides, that other countries have similar rules, and so that threshold really matters. In the US, we have something called a substantial presence test. So what that looks at is really 183 day in a 3-year period, and we use a formula and we say, is a alien, have they physically been present in the US for 183 days or more using that period or that formula? And if the answer is yes, then they're considered a resident. And like I've mentioned before, they're subject to US taxation on their worldwide income. And a lot of countries, they also look at 183 day test. It might not be the same as a formula like the US uses for 3 years, but it's still a fairly common threshold to use to determine residency. And that's obviously a really mechanical test, right? 183 days physically present in a country to determine residencies. That way it doesn't always make sense because that's just days in a country. In some countries like the US, there's certain exceptions that we can utilize, like a closer connection test, where basically, even though an individual, they may exceed that 183 day test, we can still argue that their residency is not in the US, that it's in another country. And we could look at things like on this slide, for example, family or social ties, economic ties. So where's their family located, where are the charitable organizations maybe that they're part of, the clubs that they're part of, where are the businesses that they're invested in, where are they located, where's their home, is that outside of the US? And if so, we can maybe pull all those elements together and say, even though we met this mechanical test of 183 days, we can still argue that their taxable present or their residency is actually outside of the US. And of course, with COVID, that is significant because if we're using just a strict days test, and with COVID, if somebody is stuck in a country and they can't leave and it's involuntary, it seems kind of harsh just to say, well, you're a resident now, even though you wanted to leave and you couldn't leave for some reason. Shannon, I don't know if I have control of the slides. If you do, could we go to the next slide, please? So on that same thought of residency and non-residency and that really significant threshold question, there's countries that they, like I mentioned, they'll tax worldwide income of a resident, but only the income that's earned in that country if they're a non-resident. And in addition to income tax, that's really just kind of from an income tax perspective, there are also other considerations such as a wealth tax, a gift and estate tax, or an exit tax. We'll talk about gift and estate tax in a minute, but for instance, an exit tax in Canada, if an individual is a resident and they abandon their residency or they sever their residency with Canada, Canada may say, well, we're going to look at your assets, we're going to look at what the value is and what your basis is and have kind of a deem sale on the assets. And thus that would trigger gain, and that gain is subject to tax. And so even though an individual might not be actually selling their assets, changing residency can trigger some type of exit tax. I want to also mention that, we're talking typically about 2 different jurisdictions, right? And both of them sometimes are wanting to tax the same income. And usually countries will allow for certain types of relief. For instance, in the US, if we have a US person that's working abroad and they have wages that are eligible for something called the earned income exclusion, US will say up to a certain amount, you can just exclude those wages from US tax. So you still pay tax in that foreign jurisdiction, but on the US side, we'll give you an exclusion. And other times, and this is fairly common with international tax, countries will allow for a foreign tax credit. So they'll say, okay, even though maybe you're working abroad, let's say a US individual is working in the UK and they're paying tax in the UK, the US would say, well, if you're still a US citizen, you're still subject to your worldwide tax here in the US, so you pay tax in the UK, and then we're still going to make you pick up that income on the US tax side, but we'll allow you a credit, of course, subject to limitations for those taxes paid in the foreign jurisdiction. Next slide. So far we've kind of talked about just the income tax perspective. There's also a really significant tax consideration related to gift and estates. And I mentioned for income tax purposes, from a US side at least, we typically look at the substantial presence test. And that 183-day mark seems to be a really key mark. For gift and estate, it's really kind of a different test. And instead of looking at a strict days test, we look at domicile and whether somebody is domiciled in the US. And that's typically, it's more of a subjective test and looks at the intention of the alien and whether they plan to stay in the US indefinitely. And so what can happen is sometimes you can have an individual who, for US income tax purposes, is a resident, but for estate tax purposes, maybe they're still considered a non-domiciled alien. And on the other hand, you could have somebody that they may not have met that 183-day test, so they're not considered a US resident, but they have become a domiciled alien for gift and estate tax purposes. And kind of similar to income, on the income side, where we had a non-resident alien, in the US at least, they're only subject to US taxation on their US source income, and a resident alien, they were subject to worldwide US tax on their worldwide income. It's kind of a similar concept for estate tax. If we have a non-domiciled alien, that means that really only their US situs assets are subject to US gift and estate tax. And for estate tax purposes, assets that would typically be subject to US estate tax would be US real property, for instance, or US stock is another fairly common one. So if you had a non-domiciled alien that had $1 million home in the US and they unfortunately pass away for US estate tax purposes, they're only going to be subject to US estate tax on that US property worth $1 million. And the downside is they only have this $60,000 exemption, which is like super low. And that means anything over and above that 60,000 that's considered a US asset is now subject to US estate tax, which the rates are fairly progressive and they range from 18% up to 40%. On the other hand, if you have an alien who is considered a domiciled alien, so they have a domicile here in the US, now their assets are subject to US taxation on a worldwide basis. So they look at their worldwide assets, now they're subject to US tax. And now there's a different threshold that applies. Typically the 11 million that applies to US citizens applies. So again, it's a threshold question and very significant, I think, and relevant in COVID times, in that some people may have been in the US, maybe momentarily, maybe thought it was just going to be a short-term thing, or it could be a US person in a foreign jurisdiction, and the plan was for it to be short-term, and now this has become a little more long-term and they like where they're at. There's potential that that's going to trigger some type of not only an income tax consideration, but also gift and estate tax. Next slide. So what are countries doing? You know, a lot of countries are aware of this. They're seeing this as an issue. They're aware of the issue, and what some of them are doing, they're offering almost like you can take some of those days, like if the test for residency is 183 days, they're saying, well, we'll give an exclusion, maybe 60 days, excuse me. You don't have to count those towards the 183 days. Others, I've seen commentary that are saying that, and I don't know, it's kind of comical, I guess, but they're saying that they'll be sympathetic towards taxpayers. I don't know if tax authorities and sympathetic really go in the same sentence. But I think maybe in these days for COVID, it seems like from several countries, I'm seeing something fairly consistent, and they're looking at facts and circumstances, and they're saying, well, look, if you wouldn't be a resident, but okay, you're kind of stuck here and you couldn't safely go home. And if the facts all kind of support that, even if it's not in their rules, so even if not in their statute they're allowing, like a reprieve, they're saying that maybe with existing legislation, there's just enough flexibility so that they can provide some relief to taxpayers that way. Other things that we're seeing for taxpayers that definitely have to file, so maybe it's not a residency question, maybe they're just located like a US citizen that's working in, again, maybe in the UK, and they pay tax there. We're seeing a lot of countries that are extending deadlines. So for instance, in the US, the tax filing deadline normally is April 15th. That got pushed out until July 15th. And then same thing with payments, payments that are due earlier in the year. So we're seeing some countries that are kind of shifting those out. Next slide. So that's all from an individual perspective. There's definitely, of course, a slew of considerations for companies. Companies are kind of looking at a few things, and typically when a company is starting to touch a border, that's kind of a significant event. If they're savvy enough to do the planning up front, because sometimes you can plan around having a taxable presence or having all that administration that comes with being located in another country. Companies, they typically look at taxable presence, so they're very keen on, you want to be very keen on whether you have a taxable presence in a foreign jurisdiction. Similar to in the United States, we have nexus for states, like if there's a company in Minnesota that's doing some business, maybe in Nebraska, at what point is there nexus and thus have a taxable presence and you need to file a return and need to allocate some income to that jurisdiction. It's kind of a similar concept in the international world, except we use a permanent establishment or just a taxable presence. And typically what countries are looking at is when, let's say you have a US company and it's sending an employee abroad, let's say it's India, for example, or just any country at the moment. Typically that foreign country, they'll look and see whether that US company is carrying on business in their jurisdiction. And if the answer is yes, then in general, then that would mean there's a taxable presence there. And the U.S. company needs to file returns, allocate income to that jurisdiction, and get, of course, U.S. tax ID numbers. On the other hand, the U.S. has quite a few tax treaties with foreign jurisdictions. And what those treaties typically do is they allow a U.S. company to perform more activity in that foreign jurisdiction without triggering that taxable presence. And typically in those treaties, there's language around like the U.S. company would need a taxable, or not a taxable, a permanent establishment, like a fixed place of business. So think of like a rental office, or owning an office or a warehouse, or a place for manufacturing, something that's fixed, right? Kind of has some semblance of permanence. Or the other significant consideration is related to having employees that are concluding contracts on behalf of the U.S. company. And so if a U.S. company has employees located in another jurisdiction, and they're habitually exercising their authority and negotiating and concluding contracts on behalf of the company, then typically that'll reach to a taxable presence, even under the tax treaties. So that's, again, kind of a big deal, I think, especially with COVID, in that companies may have had or may have key employees located outside the US. So directors, upper level management, officers that are kind of stuck, and well, business continues, and so they're likely making significant decisions on behalf of the company. And so in general, even under a treaty, that may trigger a taxable presence. And again, I think what I've been seeing, some commentary from several countries, is that they're going to consider COVID's effect on those individuals not being able to leave. And so they understand that business has to continue, and that maybe even if they're making those decisions on behalf of the company, that because it's temporary and not really permanent in nature, that they're not going to consider that to have a taxable presence. Next slide.
Aaron, one thing that I wanted to drive home on that point that you alluded to was, you know, high level folks in organizations that are making key decisions. There are many countries that use minded management to establish whether a company is resident there. The US is more, you know, do you have a permanent establishment or are you incorporated here? But that can be significant for those jurisdictions that look to minded management rather than incorporation location. So.
Yeah, great point. So some countries, they look at where's the management taking place, and well, if it's now taking place in another country because key management's there, then maybe that company has a residence in that foreign jurisdiction. Well, with COVID, I think a lot of people have had the experience now of working remotely, even if it's involuntary. And some of them have liked it, no doubt. And some of them may have been located in foreign jurisdictions, and they like that too. And they like working remotely, and they like being in a foreign country. And so all those things that we talked about from an individual perspective of, you know, have they established residency there? What does that mean from a tax perspective, from a company perspective? What does that mean from the company having an employee that's located in another jurisdiction? There's just kind of there's a few other issues to consider. Payroll tax, which Shannon's going to talk about a little bit more. You know, if it's a US citizen that's working abroad, maybe in Australia now, if they're still on US payroll, we're still running, you know, US payroll tax here, but maybe now the company has to register in that foreign jurisdiction for payroll, may need to withhold Australian income tax, social tax. There could be healthcare requirements for the company that they need to offer certain healthcare benefits in that foreign country. I've seen training requirements where a certain number of hours of training need to be provided, all that. It's a whole kind of different ballgame in another country sometimes. Company may need to register, not only for business, but, you know, of course, all the different tax registrations that come up. Employment law comes up. Is the employee there legally? Do they need to get a special type of visa? Just how does that look? And is there any risk either to the company or to the employee because they're located there? And the last thing that I wanted to mention is there are other taxes, of course. The tax train never really ends. And those are, for instance, a common one would be indirect tax, such as VAT or GST. Is the company now somehow required to register for GST and VAT, which is similar to kind of sales tax here in the US? And do they need to do that in the foreign jurisdiction as well? And I think with that, I'll turn it over to Shannon to talk about a mobile workforce working abroad.
Yeah, so this is sort of the best practice triangle related to mobile employees. I think some companies have, you know, already have experience with this, but some it's a new ball game. And so just thinking about things from a holistic perspective, I think now is a good time to do that, to reassess whether you think, you know, having a more mobile workforce is going to be more of a long-term strategy for you. And so really what we do is think about, okay, what is the overall company policy in terms of short-term travelers and long-term travelers or long-term assignments, what the company would like to do from a holistic approach. Oftentimes what we have is if a company is setting up in another location, they want to set up an entity there, but they want some of the existing expertise from you know, the mothership to be traveling or to be going there for a little bit longer of a period. We'd have them enter into what we call a secondment agreement, which would allow basically the subsidiary company to really employ that person from a strategy standpoint, but knowing that they may want to, for some tax planning reasons or corporate planning reasons, stay on their home country's tax or payroll. And so what we can do there is help to design that so that we meet the goals of both the individual and the company from a longer term standpoint. Oftentimes also we have companies that want to, let's say you're in the US and you are sending somebody to work in a European country. In general, the individual tax rate in those European countries is going to be higher than their US tax rate. And they would also be taxable on things like housing and a car that would be provided perhaps. And so all of those things can increase the individual's ultimate tax liability. So what companies do is enter into tax equalization agreements with those individuals to say, okay, we understand that your tax is going to be, let's say, 10% greater, so therefore we're going to reimburse you so that you're not out of pocket for that additional 10%. Well, in these, this COVID time, there are oftentimes employees that work perhaps on those tax equalization plans, and it's not happening the way that it was supposed to happen. So there may have been something that has changed within that. So taking another look at that is important during this time as well. Sometimes, as I talked about, those secondment agreements, a lot of times we have what we call a shadow payroll, where we report the payroll as if they're being paid in a certain country, let's say the US, but really they're being paid out of the UK company. And so there's some things that the company is doing to pay taxes on the employee's behalf that may need to change. Let's say they went home for the year, and so you'll want to look at those shadow payrolls and make adjustments to those as well. And then the last thing is the tax returns. Many companies will go ahead and take care of having a professional prepare those tax returns, because they do become much more complex when you perhaps have to file in multiple jurisdictions. The US is one of the very few countries, if not the only country, that taxes individuals based on citizenship. And so if you have a US citizen that is working in another jurisdiction, they most likely have to file in both places, and that can get very complex for, it's not something that a TurboTax, you would want to trust the individual to do it themselves. So that's another thing that companies often do to just minimize risk for themselves and for the company's reputation as well. Also, just wanted to talk through an example that sort of brings all of this together, and this is a real life example. So we have a UK company that employed a US citizen, employs a US citizen, and so that person was in the UK working. Things were going along as normal, and then, well, COVID happens and they decide they need to be back in the US closer to their family. But they stay on the UK payroll because they are still working for the UK company. And the UK company does have some US customers, but they do not have an entity here, an office here. So the person is working from their home, etc. And unfortunately or fortunately for the company, the employee also has the ability to conclude contracts on the company's behalf and does that. And so what happens in this case is the UK company reaches out to say, hey, what do we need to know about having this person there? Is there anything special that we need to be doing? And the answer is yes, there's actually a lot that they need to be doing. First off, the UK company is subject to the US employer taxes and withholding obligations. So what happens is that UK entity needs to go ahead and register for those taxes here and start withholding on wages. Well, that's a little bit of a troublesome thing to do if you don't have an entity here. And also, one of the things that often comes up is who is paying, where is this individual subject to social taxes, such as the US Social Security tax. So it may have been that in the UK, this person was paying into the system there as well. Now that's going to have to be back in the US again. So they'll need to be thinking about that. One thing to note on social taxes is that there are instances where you have short-term assignments, meaning 5 years or less, where there are equalization agreements with social taxes. And so that's one thing that we can look at, whether they're eligible for those. And then the UK company has potentially created a permanent establishment, which Aaron introduced that concept earlier. So they may be even subject to corporate tax on the activity that's happening in the US. And then this is where oftentimes companies will look at, well, should we just have a legal entity here to really, ring fence this activity and make sure that it's all captured within one legal entity. One thing to also note is that in this instance, in this real example, the UK company was still withholding UK taxes for this individual. Well, the general rule is that if you're providing services to a company as an employee, that income is sourced to where those services are happening. And in his case, he was performing those services in the US, but they were taking out UK payroll. And normally you would say, oh, if you're paying taxes in two places, you can get a foreign tax credit for the other taxes. But in this case, those services are considered US source and not eligible for foreign tax credit. So we got into a situation where we have to go back and try to remediate that in the UK so that he's not being double taxed. And then of course, the scariest part about this whole thing can sometimes be state taxes. If a foreign company has never come into the US and done business here, this opens up a whole can of worms in terms of sales and use tax, where they're subject to that, and also income tax. So that's just a nice way of summarizing how all of these items can play together during this time of ending up in a place where you weren't necessarily expecting to be. So with that, I'm going to just run through some of the corporate tax relief measures that have been provided with respect to companies that are really suffering, and all of these jurisdictions are just trying to help the company survive. So I've listed out a ton here. I'll hit some, in general, some of the themes in the interest of time. So one of the things is a lot of countries are allowing for immediate depreciation or write-offs of new assets. A lot of times the tax returns are being tax return deadlines are being delayed. In countries that have indirect taxes such as VAT and GST, a lot of them have brought those rates down significantly for a period of time. There's also some loss carryback provisions that have been enhanced so that if a company is running a loss this year and didn't have one in prior years, they can go back, get a quick refund perhaps, and get some cash in the pockets as well. So those are some of the high level items there, and some of the details are in the slide if you want to refer back to them. Also, I talked about indirect tax relief measures. These are by country some of the provisions that are being allowed. So delays in tax filings, and some of the reductions in the indirect tax rates as well. And then one other thing that I wanted to mention on the VAT GST side is that there are, because we have companies have a lot of customers that are in trouble as well, and they may have some bad debts sitting on the books. Consider that there are bad debt provisions in many of those countries that would allow you to get a refund of the VAT that was remitted when it was invoiced, but they never collected it because the customer didn't pay. So that's important. A lot of countries are allowing for relief in some of the enforcement policies. And in the US, you are likely aware there's been quite a lot of business support in terms of loans for small businesses especially. And many states are following suit and providing some relief. Then this last slide, which may be a little bit difficult to see, just shows the amount of stimulus that has been provided by a number of different countries. And as you can see, the US is quite large given the number of businesses that we have. It seems like a lot in total, but in terms of the percentage of GDP, we're about in the middle of the pack. So interesting to see that as well in terms of where that stimulus is being provided. And of course, the one thing that always is concerning is, okay, well, how are we going to eventually pay for that stimulus? And that could be a challenge, and we may see adjustments to tax rates swing the other way after this is all back to normal. And so that's a little bit something to be keeping your eye on in terms of changes in tax rates by country as we go forward for multinationals. So with that, I will wrap up and turn it back over to Doug.
Doug, you're on mute if you're talking.
I'm always the one that's saying turn off your mute, and I didn't turn off mine. Sorry about that. Thank you to both of you. Great information. I thought it was interesting, Shannon. The example that you gave seemed to be incredibly frightening from different angles, and the way you kind of buttoned it up at the end, you said it was a nice way of summarizing, which I took to mean that it's scary out there right now.
Yes,
so there's a lot going on that COVID is promoting, right? I made me think of one of our members who's stuck in Japan right now, and because she doesn't want to leave because she has to service some clients there. And so presumably your example and some of the things that you talked about are addressing those people. They should definitely be talking to their accountant, right? And that's the reason why you're mentioning that, because there are some implications of the way people are living right now that have tax implications. Is that the case?
It is, and I think because this happened so quickly and people were just trying to get by, some of those detailed issues were not considered right away. And now we're in a place where, well, this is still going. And so we need to sort of step back and evaluate what is our longer term strategy with respect to these people. And we have seen even companies setting up in the US, for instance, just because COVID has put them in a place where they need people here for the long term. And so that has been an interesting development as well.
Got it. So I'm going to open up the floor now to general questions. And so if you have a question, please, you guys in the Global Tribe know the drill, either in the Q&A section or in the comments section, or send an email to info@globalchamber.org and we'll get the question asked of the experts. One of the questions that's already come in is regarding kind of the holistic approach that you take, or whether it is or not. You mentioned a lot about companies that have employees in different locations. You guys are both based in the US. How does the firm handle situations where a company has employees all over the world, have different tax jurisdictions? Do you handle that, or do you outsource it? How does that work for a company?
Yeah, so there are a number of different strategies that companies can use. For us, if a company is US based and they have employees and locations in other countries, we can certainly help with the global planning, right? Making sure that we as a whole have minimized the tax liability and obligations. But if they need assistance on the ground in another country, what we do is reach out to our member firms. We're a part of a network called HLB International. And so we reach out to them to have them really help with the on the ground sort of issues that come up.
Got it. So that's something that you can kind of either both handle for them, but also you can direct resources to them as well.
Yeah, one other thought about that as well is oftentimes companies find themselves in this position where they just need to hire a person in a country, right? So they don't necessarily need the whole legal structure, et cetera. And sometimes there are reasons that you would want a legal entity, but there are also international PEO companies that offer this service. So that's something to consider as well in terms of looking at hiring a person. Let's say you have an employee that moved back to Germany for the specific, COVID season, and now they've decided they want to stay and you want to retain them. That's another strategy as well.
I see. Do you ever get involved, I presume you do, with employer of record cases where you've got, a company might have an employee in Germany, but it's not really their employee?
Yes, absolutely.
Okay, so that's an area that you handle as well.
Mm-hmm.
Got it. Considering what's going on in today's world, certainly one of the issues that you raise that people should be checking in on is the residency issue, considering what COVID is driving. Are there other issues that you're seeing out there, whether it's specific law, maybe tax law changes, or other things that people should be aware of that have been changing over, let's say, the last 6 months to 12 months?
Well, I would say tax deadlines comes to mind immediately, because people kind of get in the routine of filing tax returns by a certain date, having all information done by a certain date, and that's just, of course, been disrupted considerably as a result of COVID. So new filing dates, new opportunities to maybe extend making payments for taxes, and I think taxpayers have been appreciative of that, especially given some difficulties with COVID, being able to push out when there's going to be that cash outflow for income taxes.
Yeah, and we have some tools, Doug, that help companies with that. So if you have subsidiaries in, let's say, 5 different countries, and you want to know what those provisions are, those changes related to COVID, we can pull that into a chart relatively quickly. So if anybody's interested in that, we'd be happy to help. The other item that I would say with respect to this is transfer pricing is really key in this period of time, where you may have some losses happening somewhere, which may be appropriate, but may not be appropriate. Maybe it'd be more appropriate to have those losses being allocated to a different jurisdiction. And so really reevaluating transfer pricing in terms of where your functions and risks are sitting, because that may have changed during this period of time. So taking a look at transfer pricing is important as well.
I see. For those things, in particular the specialty areas like transfer pricing, how do you as a firm handle that? Do you have internal resources that you pull from? You have other maybe contractors that you work from? How do your clients get that kind of expertise?
Yes, we have a mix of that, actually. We have some folks within our organization that can help with the high-level tactical planning. And then when we get into the details of some of the more compliance matters that you might need, like the transfer pricing documentation as such, then we outsource that as well.
I see. Got it. So Shannon, you've been doing this for 20 plus years, I think, right?
Mm-hmm.
So
yeah.
Has it all been with Eide Bailly, or did you work somewhere else prior?
Yes, I did. I spent a number of years with EY and BDO. So in both of those organizations, actually started my career with a couple years at PwC as well. So I'm at my last stop. I'm not going anywhere. But the one thing that I love about Eide Bailly is just really being able to work with the entrepreneurs. Really, I feel like we're really making an impact, because we're not working with the large, corporate tax departments, which are great, but they already have a lot of things that they need. And we are really helping businesses in that initial stage of, what do we need to be thinking about as we're going global? So that's really rewarding for me.
You've got an interesting, meaning Eide Bailly, has an interesting business model where, I believe the headquarters is in Mankato, right? So, and then you've got historically cities that are kind of like the second tier, not the premier cities. Until this year, I understand now you've got like, for instance, offices in Los Angeles area, but until then, really a lot of places like Salt Lake, great city, but not necessarily the New Yorks and the Londons and places like that. So how has that impacted the types of clients that you've handled, and then what does it say about the company? Because I get a sense that from direct experience and indirect experience that you guys you feel like a hometown friendly, capable group that sometimes definitely not the city slicker feel.
Well, thank you. That's a compliment for sure. Yeah, so Eide Bailey is 103 years old. We're headquartered in Fargo, North Dakota, actually.
Okay.
Yeah, so just as you said, we're typically in, the second tier markets, aside from some of our larger offices like Denver, Minneapolis, and Salt Lake is now, or I should say Utah. We have many offices in Utah, and they're a very large office as well. And what we found is those are underserved markets for the most part, and so we're able to provide that really intentional holding hands with companies to help them through some of the business decisions that they need to make. And in terms of our expansion, especially the one into California, California is made up of some amazing middle market companies, and a lot of high net worth individuals that haven't gotten the attention that they need. And so we see that as a wonderful opportunity as well. And Aaron, I'm not sure if you had any other thoughts to share on that.
No, just kind of going back to the types of clients that we work with. It's a lot of fun to start from the very beginning of, hey, I have this idea of maybe doing something in a different country, and then being there to be able to help and work all the way through that to seeing it as reality. Whereas sometimes with bigger clients, although it's fun both ways for me as being part of international tax. There's already a plan, and it's just, okay, let's implement, and it's just the tax side. But what we commonly see is companies that, they're just kind of brainstorming, and they're trying to figure out what's this going to look like. And given that, we work with quite a few different clients, quite a few different stages, it's awesome to be able to bring that expertise in and like I said, kind of go from zero all the way to ramped up to a full expansion.
So it sounds like the entrepreneur and small and medium-sized enterprise is kind of the sweet spot for the firm.
That is correct, yes.
Yeah, great. In terms of some of the things that you're seeing out there today, how should companies approach this? It sounds like what you're recommending is a more proactive approach, maybe more proactive than normal, to understand what some of these changes are and what the impacts could be when tax season resurfaces. I presume that's what your key recommendation is from today.
Yeah, I think that like I said, when this all first happened, there's so much uncertainty, and so you don't want to react too quickly, and you want to be intentional about the reactions that you make. And now we've had enough time to really think about what this means and what this could mean for the company in terms of the more longer term strategy. So stepping back and saying, okay, does it make sense to keep somebody there? And there's a war on talent at the moment. So, if you have somebody that has needed to be closer to family or needed to move to another location, maybe it makes sense to think about that from a long-term perspective as well. And that could bring some opportunity. We've had, like I said, a number of companies that have come into the US. It's a huge market. And, maybe there is some strategy to start expanding here as well. So, and that has happened on the flip side in other jurisdictions.
I presume those types of companies that are landing in the U.S. are also targets that you go after and are able to help.
Yeah, that's definitely one of our sweet spots. Our firm, we generally, those calls would, come through the international group, just because we have the expertise in helping them understand what they need to know, even from the very beginning, from everything from, sales and use tax to corporate tax, et cetera, and how to structure. And we have the familiarity with the jurisdictions that they're coming from, so we can talk in their language as well, not necessarily in their language, but we know some of the issues that are going to pop up for them. And so What we are able to do is help them really just land and expand. So if they need bookkeeping services, which a lot of them do, they don't want to have, somebody that's here just for bookkeeping in the initial stages. If they need assistance with state registrations and things of that nature, we can help with that. In specific industries that we might have expertise in, we can help them with understanding where, in the country those opportunities might be, et cetera.
Got it. Okay, that sounds good. Aaron, what are some of the things that you're seeing right now, and maybe some closing comments on any recommendations that you have for people out there as we navigate this interesting time?
Yeah, I think, from companies touching other borders, of course, on our side, it's always, hey, can we do it beforehand and do the planning? Because it's usually easier just to do the planning and try to navigate whatever, rules that we have, rather than trying to come in and clean things up afterwards. And I think what we'll probably be seeing is that for 2020, of course, we haven't filed any 2020 tax returns yet, right? So the people that wait all the way till 2021 and they say, hey, here's my tax situation, at that point, it might be too late for us to do much other than just make do, with what we have. So I think for companies and for individuals who are, maybe in a situation that's a little different than the past, just have a conversation with your tax advisor and bring it up and just say, is there anything that I should be thinking of, before year end, if I can still change something before year end, so I'm not in a nasty tax situation. I think that's highly recommended for all kind of the reasons that we mentioned throughout the slides. It'll mean much less aspirin during the filing season for 2021 for the taxpayers. I think quite a bit less.
A lot safer and better sleep as well, I'm sure. Shannon, in your case, what recommendations do you have, and what closing comments do you have? We're getting closer to the end of the program. I wanted to mention that I presume that the slides, you let us know, but let us know if the slides are available more generally. We're happy to share it with everybody who's watching today. But you let us know if that's possible. And then what other things would you like to mention before we close today?
Well, one of the things that we touched on briefly was just some of the stimulus items that have become available in various countries. So really, exploring those as well, looking at what what could be available for your company in terms of getting some of the reliefs that are available. So that would be another recommendation, besides just taking a step back and doing the global planning.
Sure. So checking out both local and federal programs. A lot of people finishing up their PPP or other program wrapped up, I think, by the end of the year, right? So all of that needs to be cleaned up.
Right.
Thank you both for your time today. Really great information. We will, as I mentioned, we will share this information. It'll be in a blog post along with the recording, and then the content of the material is available to all the participants. Really want to thank both of you to sharing your expertise today. Our members and our viewers today are a lot smarter and hopefully more prepared. And definitely, I think the key message that I heard, among others, was, don't wait until January 1 to figure out like what your 2020 tax liabilities are. Do it today. I presume that you can reach out to either Aaron or to Shannon both. If you don't have their contact information, send an email to info@globalchamber.org and we'll get you connected and have a conversation and see how they can help and hopefully save you a few dollars for the coming year. Thanks, everybody. I really appreciate your time and have a great rest of your day. Take care. Thanks, Shannon. Thanks, Aaron.
Thanks, Doug, for the opportunity.
Thanks, Doug. Take care.
Take care. Bye-bye.